Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day today. And in today's markets, guys, well, as you can see, the SPY, the QQQ, and most major sectors did end the day in the green today. That was in spite of all the major news headlines that hit the tape over the course of the session. News headlines anywhere ranging from a Federal Reserve meeting with Jerome Powell, which we'll cover in a few short minutes. News that brought Google down 7%, where during the DOJ investigation lawsuit court hearing today, Apple was saying pretty much that maybe Google's search numbers were not as strong as they appear, as they had noted a search decline in the month of April, and that Apple was exploring possible partnerships with Anthropic and Perplexity to maybe replace certain search functions in their Safari browser. That was not good nor for Apple nor for Google's companies today in the markets. They both ended up red. We also had at the very end of the day a very big news headline where the Trump administration said they wanted to rescind the Biden-era AI chip export curbs, which was kind of hinted at yesterday when we brought this news up in an interview from Jensen Huang from NVIDIA, where he was basically saying, let the chips flow to China and we will show them that we still have the best chips, but we don't want to lose access to that $50 billion potential market. All of those news combined led to a somewhat very volatile session, and we're going to recap it all for you guys today. So in today's video, we're going to cover a few things together. Number one, cover all of those major news headlines that I just talked to you about. Number two, we're going to be going over, of course, our company earnings, and there's a few of them to cover today. 4 of them, as a matter of fact. I will be covering Uber, Disney, AppLovin, and ARM. Now, shout out to another batch of companies that we also had earnings today for, such as NVO, such as Mercado Libre, which is not on this list, Dutch Bros, and so many more that I could cover. But for now, I'll be covering those 4. And maybe on the Friday session, I'll be able to recap some of them that we missed over the course of the week. So that's going to be element number 2. Thereafter, we're going to be doing our major technical analysis rundown of our major stock market indexes, followed up by our big tech names, see whether some or all of these companies still remain at attractive levels for either trades or possible long-term portfolio buys. And that's going to be it. No portfolio update for today. As you guys know, I do them on a Monday or Friday. Been a very good week for us so far, trading in the markets. So can't wait to give you guys a more broad update come the week close after the Friday session. So without further ado, should be a very fun video. And I know these videos are long. If ever you want to skip to a certain portion, always feel free to jump down below in the video description where I have all the links to the different timestamps. So let's jump right into it, shall we? The SPY up about 0.42%. The Qs up 0.39% overall. And as we can see, it was a fairly nice broad day of market performance, where you only had really Google and Apple dropping in a fairly big way, at least bigger than the rest of the market, right? Most of big tech was good. Semiconductors were kind of flat on the day until that end of day news on the semiconductor news, right? That we'll cover in a few short moments. And Microsoft just flat, but really it was only a question of Apple and Google overall. Financials did okay. We can see that healthcare also slowly crawling back after being muted for the last roughly 2 weeks of time. And even the bottom half of the market responding fairly well. So you can see it was a broad day of market upside, but the upside gains were not phenomenal, right? Just a normal average green day. You can see that best on the 1-day relative performance, where we did have a number of sectors, but none of which really exceeded the 1% mark. It was led to the upside by technology and healthcare and consumer cyclical, to the downside basic materials and communication services. I'll remind you, Google is a very large component of that sector overall, so that's why they were mostly to the downside. 1 week relative, you can see that technology and industrials have been outperforming everybody else, and healthcare still remains a dead weight on this market right now, but nice to see them finally putting in at least 1 day's worth of green. We'll see if ever that is going to be able to last. So before we get into more technicals, guys, let us jump through the news articles and then we'll head right into earnings, shall we? So the Fed meeting recap here. Powell rules out a preemptive rate cut to blunt any tariff impact. Now, usually we spend 4 or 5 minutes on the Federal Reserve recap, but there's really nothing to be said this time. It was kind of a nothing burger. The Fed did not change interest rates at all and said that he refused to cut rates preemptively to, as the article says, blunt any tariff impact whatsoever. Powell was reiterating the fact that the Fed is in a good place right now. Unemployment remains low at 4.2%. And also the fact that the economy, as measured by GDP, also seems to be quite good. I'll remind you, we got GDP last week, which showed that we had a negative quarter-over-quarter impact. However, a lot of that was driven by the sheer amount of imports that people did to front-run the tariffs. If you were to take in consideration final goods and services purchased domestically by both consumers and producers alike, that number was actually very solid at 3%. So that is what he was basing his analysis on. And when asked, well, why wouldn't you do it? Why wouldn't you just cut rates because you know that things are going to be bad? He said, well, we don't know how bad they can possibly get, citing a lot of uncertainty surrounding the matter. We don't know if the tariffs are going to be kept in place. We don't know how many people could possibly lose their jobs and a number of different things like that, right? So he was saying that depending what happens, right, if inflation becomes the problem, then they have to do something different, as if the problem is more for job loss, right? So saying that either of those two things will require different responses from the Fed, which is why he doesn't want to preemptively do anything. So I was under the impression that the market would throw a little bit of a temper tantrum, being impatient surrounding the rate cuts. But as a matter of fact, the market did respond well to those comments. And that's pretty much the only recap I'm going to give you, because nothing really else was said. He gave the exact same answer to every single question around the tariffs. It's just there's too much uncertainty right now. So they would rather wait for the hard data to come in and then react to it. You could argue that maybe they're going to be late when that does happen, but apparently that's the stance that the Fed wants to take. That's piece of news number one. Piece of news number two was a very big one here, guys. This all came out. Currently, Google is in a court session to determine, because the Department of Justice sued them last fall over their search dominance and search monopoly. And who was speaking during this court hearing today? Well, an Apple executive. And what did the Apple executive had to say? Well, a couple of things that were not good for Google. The Alphabet and Apple share sank Wednesday after Eddie Q, Apple's services chief, said he believes that AI search engines will eventually replace standard search engines such as Google. Q said he expects to add AI services from OpenAI, Perplexity, and Anthropic as search options in Apple's Safari browser in the future. The Apple executive was testifying in a federal court in Washington as part of the Justice Department's lawsuit against Google. Google pays the iPhone maker billions of dollars per year, $20 billion per year, all the way back from 2022 for their exclusive partnership deal, whereby Google is the default search browser within Safari for every single iPhone. So obviously that's a lot of money for Apple, but it's also a lot of volume for search for Google. If they were to change that by replacing Google by either Microsoft or OpenAI or possibly Anthropic or Perplexity, well, obviously you understand that Apple's probably going to lose a lot of money. Maybe they won't get as much as 20 billion from the new person or new people. And maybe as well, Google's going to lose a ton of search volume. Not good for either company. That's why they were both down. Q's comments cast doubt on the long-term stability of the relationship. Q said he believes Google should remain the default search option on Safari. So he did say that, but he didn't say that he wasn't going to add any more tools, right? Saying he has lost sleep over the possibility of losing the revenue share from the two companies' agreement, according to the report. The Apple executive said searches on Safari declined for the first time in April, which Q attributed to the rise in people using AI. So that's the reason why Google was down 7% today, almost as far as 9% at one point, and Apple was down over 2% before ending their respective days. Google down 7.51 and Apple just down over 1%. So definitely not a fun time to be a Google shareholder. It just continuously gets hit by these news headlines, and that has been the case now for about the last 6 months. That's piece of news number two. Now, a better piece of news for the market overall was what came in at the end of the day, almost 10 to 15 minutes before the close, and it was the following: Trump administration to rescind the Biden-era AI chip export curbs. Now, this new piece of news is very timely. Jensen Huang has met with President Trump 2 times so far since the inauguration back in January, and although we don't know exactly what was said, we can pretty much determine from his attitude in the interview yesterday what Jensen was probably saying, right? Yesterday, he was commenting again in another interview yesterday. Here's what he had to say. It would be good to make the American standard the standard. Jensen Huang saying, free the chips. The market we have left behind is utterly gigantic, talking about China, right? And the export restrictions towards them. Huang says the free flow of chips would help bring back tax dollars to the US and also create jobs. It's a big market, guys. It's $50 billion potential total addressable market for those chip exports towards China. And Jensen Huang said yesterday, like, they have no problem competing. As a matter of fact, they want to compete against Huawei. They want to show who is the best of the best and continue dominating the entire landscape. But it's very hard for them to do that when there's so many export restrictions towards the country. So now Trump coming out today, the administration saying that they're going to rescind the Biden-era AI chip export curbs. This was issued by the Department of Commerce in January, those final Biden rules on export restrictions here, and they were to come into play May 15th. That will not be happening anymore. They will be replaced. The Biden AI rule is overly complex, overly bureaucratic, and would stymie American innovation. We will be replacing it with a much simpler rule that unleashes American innovation and ensures American AI dominance, said the spokesperson. So we will have to see what those new sets of rules entail, but a lot of chip companies rallied hard into the close on that, especially NVIDIA, which was largely flat on the day, but ending the day up 3.1%. So that is all your news recaps for today. Hopefully you guys enjoyed those. Now let's dive into some fun stuff, and we're going to be diving into earnings. I'm going to start off with a very fun one, which is going to be Uber. So in terms of Uber, they had earnings this morning before the open, and throughout the day, they were down as much as 5%, but end of the day, only down 2.5%. Now, in terms of their numbers were actually very, very good. They showed an EPS increase by 63%, very good for them, but they had a tiny little miss on revenue, which did contribute to a bit of the decline. Now, front and center in Uber's earnings was their exposure to robo-taxis, essentially, right? The criticism of Uber's business over the last 6 months is that eventually, right, autonomous vehicles were going to take over and swallow Uber's entire network. And the pushback was that, well, if that's the case, it may only be 5 to 10 years out, and Uber will not go down without a fight, right? It has a tremendous network, and oftentimes will engage with these autonomous vehicle providers on their network. They will put them there so that people can choose whether they want a manned ride or an unmanned ride. So let's have a look at some of Uber's numbers, shall we? In terms of the numbers, they were very good. Uber's revenue was up 14% year over year. Bookings were up 14% year over year as well. Active users was very strong, 14% year over year, 170 million active users. And EBITDA was up as well. Uber being a very profitable company right now, their margins keep rising and rising and rising as they continue to scale the business. Let's have a look at the headline, shall we? So Uber misses the revenue expectations while trips were up 18% over last year. That was very good, as a matter of fact. Let's have a look. They fell shy, however, of the anticipated revenue growth for the quarter, another reason for the decline. So they reported a net income today of $1.78 billion. That was roughly 15.4% net margins, which is very good in the grand scheme of things. I'll remind you, not too long ago, Uber was a money-losing company, and that all stopped in 2023. And we can see some very net progress here over the last few quarters and last few years, and now this quarter again showing nice double-digit growth. Now, Uber has never had a problem with gross margins. They've just had a problem scaling in to overall profitability. As you can see, the gross margins here, follow my mouse, are now up to the low 30% range, and they're bringing more and more of that money to the bottom line. Another very strong quarter for them, this one as well. Let's move on further, shall we? 60% of the company's gross bookings in its Uber Eats business come from Uber One members, and that the subscription service is growing quickly. So not only are they providing very good Uber Eats numbers overall, but a growing number of their members overall. The people that use Uber and Uber Eats are queuing in to their Uber One subscription, which is a paid service. Obviously, they make a lot more money on that. Now, mobility was up 13% year over year. And delivery gross bookings was up 15% year over year. So both lines of business for Uber moving up and to the right by double digits. The monthly active platform consumers had grown to 170 million, as we just saw. Users booked around 3.04 billion trips during the first quarter of 2025, and that was up 18% from the first quarter of 2024. Can you imagine, guys? 3.04 billion trips in 3 months. What a very strong business. Uber has been making a push into autonomous vehicles. Here's the headlines everybody wants. The CEO said the company views AVs as the single greatest opportunity ahead for Uber. So not thinking of it as a threat, thinking of it instead as an opportunity to utilize their very powerful and very wide international network. Uber allows app users to book robotaxi rides in some US markets or order food for delivery via autonomous vehicles in others. Very interesting. Uber, the Uber CEO said that they reach an annual run rate of 1.5 million autonomous vehicle trips. So you could argue that more people use robotaxi services via the Uber network than they would otherwise use alone. And obviously Uber gets a little bit of a cut of that, right? So Uber's competitive advantage in this space for autonomous vehicles is that they have access to so many customers. And I'm pretty sure most robotaxi brands will want to be a part of Uber's network so that they can get their brand awareness out and start putting people in their cars. Let's move on to some earnings slides, shall we? So the market leadership continues to dominate. They are the global leading delivery player operating in over 30 countries. Growth was very good, right? 18% year over year in gross bookings, which is very strong. Profitability, very nice as well. 3.1 billion in adjusted EBITDA. Average recurring revenue, which is annual recurring revenue, which is extremely strong, guys. Extremely strong push on revenue and net margin profitability for them. They are pursuing massive opportunities in local commerce through new products and tech. Now, some you may not recognize just yet, right? We know for consumers, they have restaurants and whatnot, but now they're doing groceries, convenience, alcohol, of course, electronics, home improvement, pets. So they're really starting to deliver absolutely everything. And even merchants, Uber Eats Marketplace, right? Direct pickup, dine-in, advertising service for them brings in a lot of money, offers and data analytics on their massive consumers. So they're really monetizing their consumer base, both in terms of for consumers and also for merchants that are seeking to look for more data, right? So moving on further here, we can take a look at the memberships. Delivery gross bookings coverage reached 60%. Right, of now Uber One members benefiting from those decent little discounts and reductions or removals of the delivery fees. That's what a lot of people want to get away from here. And in terms of consumers, 30% of delivery first trips come from the mobility app, of course, which is very good. Now, of course, they're partnered with a bunch of people, but we're not going to go over that. You guys already know that. Let's move on to some metrics, shall we? So monthly active consumers right here, 14% to the upside, looking very, very, very strong on a quarterly over quarter basis. Monthly trips per consumer is also very, very strong right now. 3% growth overall. And that number is just continuing to expand as more people use the platform, but they also use it more often. And overall, a little bit less trips than Q4, which is usually Uber's busiest quarter, but a very decent uptick over the same period of time in 2024. Looking very good. Gross bookings, as we saw, up. Q4 is usually Uber's best quarter. Now all you have to do is measure on the comps Q1 last year, and you can see a very nice growth curve right there, 14%. Revenue as well, we already took a look at that, up and to the right, which is exactly what you want to see. They're becoming a more profitable company as time moves on as well, which is also exactly what you want to see. Mobility highlights, we saw that again, gross bookings up and to the right. Revenue, the revenue run rate, very strong up here, right, in terms of 18% year over year. And the revenue margins are getting better on mobility, which is exactly what you want to see as usual. Delivery, same concept, right? Gross bookings up and to the right. Revenue margins are also staying very stable in the high to mid 18% range, and EBITDA to the upside. And freight highlights. Well, this is an up and coming business for Uber, but still bringing them $1.2 billion. That was a loss measured between Q1 of last year. We'll see how that one goes. It's still a very new line of business for them overall. So truly, guys, on Uber, nothing bad to say. This was another very strong quarter for a very strong company, and they are embracing the autonomous vehicle aspect of the business as well into the future. So at $83 right now, at the all-time highs, have we missed the boat, or is it still a good buy? Well, here's the look, right? At 83 bucks, you're trading at a 33 forward price to earnings. A little bit high, but they are growing EPS at 26% per year through 2027. In terms of the PEG ratio, you're sitting at a 1.26 PEG, which is fairly good, guys. That's not too bad considering their high EPS growth rate. And you're sitting at a trailing 12-month free cash flow yield of 4.5%. All very good metrics overall. We can take a look as well at their balance sheet. You guys will see that although they do have some debt, not a lot of free cash flow they bring in per year and decent cash on the balance sheet. And down below here on the forecast, you can see that Uber will be expanding EPS for every single one of the next 4 years as they expand profitability, and will be expanding revenue very, very, very attractively over the next few years as well. Currently, in terms of forward, they're trading at about a 3.5 forward price to sales, which is not all that bad, all things considered, right? Matter of fact, if you were to take a 4 price to sales as a target range for Uber, I mean, in terms of 2028, they'll be making $73 billion in total sales. So if we just take a 4 price to sales times roughly, let's call it 74 billion in sales, right? 296 billion should be the terminal market cap, which would be some nice upside from here. It's trading at about 175, 69% upside, right? Which is roughly, let's call it about 15, 17% compound annual growth rate through 2028. Not the worst, right? That 60% upside, 70% upside would put the stock all the way, well, higher than that, all the way probably up to roughly 130, 140. That is for a long-term investment. So here, if you have a long-term time horizon, it's not a terrible buy, but I was telling everybody that it was a much better buy back here, and that's why we did accumulate some shares ourselves on the channel overall. So if I had to be a bit more patient or embark on a DCA process, you know, if I really want to position on Uber, maybe I'd start with something like a quarter position or something like that. And if the markets continue unraveling throughout this year, if we get damage from the tariffs and whatnot, you know, 70s or below 70s is really the target range where I'd like to accumulate a bit heavier on the Uber side, but very strong earnings for a very solid company. So that's pretty much everything for Uber. And now we have to get into another fun one, guys, which is going to be AppLovin. So AppLovin, this is going to be the first time that I cover this company's earnings on the channel. I know, it's been a long time coming, but since it's so popular with the retail trade, I will definitely take a look at this one with you guys and provide my thoughts. So AppLovin right now in the after hours up 13%. They are no stranger to very large earnings gains, and today was no different. So in terms of the numbers, guys, they crushed it. 16% beat on EPS and a 7.5% beat on revenue. Now, the concern for this company has always been that the valuation has been very, very expensive ever since they went up this day, 46% after earnings just a few short quarters ago, right? Down here was a pretty good deal, but all the way up here, it's been a constant concern. Does the valuation support the current growth at hand? Well, let's have a look. Let's take a look at the headline, shall we? So, AppLovin shares pop on earnings beat as it announces the sale of the mobile gaming business. So, I'll remind you what AppLovin does. They have 2 lines of business. Number 1 is they have a division of apps that they have either acquired over time from other companies or have built themselves. Now, that series of apps is a less profitable line of business for the company, but also it generates less quick revenue growth overall. So they have their own apps that they've either bought or have made themselves. Then the most profitable line of business, which everybody's been raving about, is their advertising division, which is seeing leaps and bounds with the implementation of AI. Basically what it is ad placement software for mobile apps, whether it be games and others. They are very efficient at really targeting consumers with the perfect ads, depending whether you're playing games or depending whatever you're doing on your phone, right? If you have an app, if you're an app developer and you have an app and you want to run ads on it, what type of ads do you run? Well, AppLovin manages that all for you, and it's a very high growth division of their business for them. So let's move on further, shall we? So into the actual article, we already said they crushed earnings and crushed revenue too. AppLovin agreed on Wednesday as well to sell its mobile gaming business to Triple Dot Studios in a deal worth 400 million in cash considerations. This is one part of the apps suite of AppLovin business. The advertising tech company will also obtain a roughly 20% ownership stake in Triple Dot Studios, which makes mobile games like Sudoku Friends, Puzzle Time, and Solitaire Classic. Pretty big company for what they do. AppLovin said second quarter sales should come in at the range of 1.2 to 1.22 billion. However, that was trailing the estimates by about roughly 10%. The estimates was 1.38 billion overall for those second quarter sales. Now, first quarter net income was 576 million. That was pretty good overall, guys. You're talking about 39% net margins overall. And AppLovin has never really had a problem with gross margins, having positive gross margins. It's just for a long time, they couldn't bring a lot of that to the bottom line as they were trying to scale the business overall. But gross margins has never been a problem for the company, guys. Take a look here. Over the last roughly 6-7 quarters, you can see gross margins have just expanded. A very profitable company on the top line. But then when you remove all the operating expenses, as you can see, net margins were low, but now they've crept up into the high 30% range, even the low 40% range. So turning into a very strong and very profitable company. Let's move on. The ad tech firm said in February that it had signed a term sheet to sell its apps business overall for a total estimated consideration of 900 million. Well, they've already now sold the mobile gaming portion of that app division. Now they're going to have to sell off the rest, which included 500 million in cash. AppLovin's business has been split between advertising and apps, which is primarily made up of the game studios that the company has acquired over the years. With the historic growth in its advertising unit, due to rapid advancements in AI, the apps business had become much less important to the company. The company logged $1.16 billion in first quarter advertising sales, up from the $678 million, so almost up to 2x on ads, the ad division of the business. What about the app division of the business? Well, here you go. Sales of the company's app-related business for the quarter came in at $325 million, which was a 14% decline from the prior year. Now you could see why they want to sell off this division of the business and stick with the advertising one. And now moving into the actual slides for the business, you will see that revenue was up 40% overall. That is apps plus advertising. Net income, as we said, was margins of 39%. The advertising revenue division grew 71% overall. Fantastic. But the apps revenue decreased 14%, as we had just said. Now, overall, they did generate a decent amount of free cash flow, talking about $826 million of free cash flow, which is not bad for a company of that size. Here's your revenue curve. Here's the advertising curve as well. And as you can see, net income, which is your purple box right there, has been steady moving up and to the right. The fourth quarter was the best quarter for them. Downtick from there, but a net uptick from the Q1 2024 period at the same time last year. Now, in terms of percentage of revenue, as you can see, the purple line is your net margins overall. They've done a fantastic job of almost doubling net margins in almost under a year's worth of time. So fantastic job for them. And here you see cash flow and shares outstanding. The cash flow, the free cash flow is your light blue box right there that is up and to the right, and your shares outstanding is the line. So no more dilution for the company. They've actually started to reduce the share count ever so slightly, which is good if ever a dilutive event is a problem for you. Well, this is not a problem for the company right now. Overall, fantastic numbers for AppLovin. We've been through much of the stuff already. In terms of their other financials, such as the balance sheet, you can see that although they do have a decent amount of debt here on the balance sheet, they bring in a lot of free cash flow per year, and this quarter was no different. I'll remind you, we literally just saw that they brought in a tremendous amount of free cash flow this quarter, $826 million. So debt is not a problem for them, and they have a small amount of cash on the balance sheet already. So balance sheet is looking pretty good. And in terms of the forecast, well, the forecast, they're going to be skyrocketing EPS over the next few years, a very strong EPS growth rate, and revenue is also not said to be slowing down. 2028 is just an estimate for now. Maybe this gets revised. It says it's lower for now, but I'll take it through 2027. You can have some very fantastic expansion through 2027. They didn't post the EPS for 2028, so I'm curious how they obtained this number right here, but we usually take it 3 years forward, so I'll just stick to through 2027, in which the revenue is clearly appreciating up and to the right. Now, that gives them a revenue growth rate of 20% per year and an EPS growth rate of 39% per year, but this will not always be the case. It will slow down eventually. So when I do this valuation, keep that in mind, yeah? So at $350, guys, is it a good deal? Well, forward price to earnings is a 53.76 overall. When you normalize that with the PEG ratio, you're sitting at a PEG of 1.38. First glance, it doesn't appear expensive, right? Anything under 1 is cheap. Between 1 and 2 is okay. Anything above 2 starts to be a little bit rich. 1.38 is fine, but keep in mind, they're growing EPS at a very fast clip. Eventually, you hit the law of large numbers, and the EPS revenue growth rate will decline overall. So I'm taking 39% right now, but if you take a longer terminal growth rate number, the PEG ratio for a longer duration can probably go up. So when we have these large swings in EPS, sometimes what you want to do is look at something like a forward price to sales, but forward price to sales here is also very high. It's at an 18.2 right now. So let's just say, for all intents and purposes, that somehow, because usually tech companies, a terminal price to sales for them is between like a 10 and 12. And that's top end, right? It can go between 5 and 12. 10 to 12 is like top end, right? So they're at 18.2 right now. It's very high, but the company's growing a lot. But let's just say we go out to 2027, they have about 8 billion in revenue, yeah? 8 billion. Let's just say that, yeah? 8 billion, and I give them the top end of the average for most tech companies out there, which is 12. You would get a forward market cap of roughly 96 billion, yeah? Which is under the current share price right now. But let's just say as well that for some which reason, Wall Street allows them to trade continuously at a 20 or 18 forward price to sales, you would take that same 8 billion and then you would project it out, right? With an 18 forward price to sales every single year. And then you'd be seeing an 144 billion market cap, which would give you about 40% upside from here, which would mean the stock can, through 2027, appreciate back to maybe, 430 or at the top. And if things get crazy again, all the way back to the all-time highs. So it's all a question of perception. It's about how much do you believe that Wall Street will allow this one to trade rich? Because let's be honest, it does trade rich. How long will that be the case? Well, that's why you got to know, right? How much you're paying for these things. So at $350, it's not the cheapest, but if for some which reason you find it back down here over the course of this year in the lower 200s, their growth isn't affected, but maybe let's say the markets overall, the SPY QQQ, they bring them down because of the tariffs. Well, then you know that you're getting a better entry price. I've already given you the terminal value. That's not going to change with a between 10 to 18 forward price to sales metric, considering their 2027 sales. I've given you the top end of the range. It's somewhere up here in the $450 range. So are you getting a better deal if you buy it at $350 or if you buy it at $200? Well, the company stays with the same fundamentals, but maybe just the market drags it down, right? Those are all things you have to keep in mind. So here, I'm probably not going to buy, but if I do see some weakness, I may be considering a little bit of a nibble on AppLovin. But keep in mind, it's a high beta stock. This stock moves with the rest of the market. The SPY, the QQQ stay healthy. This one will go up and will go up faster. But if the SPY and QQQ take a negative event, well, it'll go down and it'll go down faster. That's the byproduct of this stock having a 4 beta. So keep that in mind. It is a, other words, high risk, high rewards play. There's a lot at stake for this company, but overall, it is a fantastic business with very strong margins. And that is everything I had for you guys for AppLovin. Now, company number 3, we're going to slow it down a little bit from the high flyers, and we're going to take a look at Disney. And Disney coming out, as a matter of fact, with one of their arguably better quarterly reports that they've published in a very long time. We've been tracking this one on the channel publicly, guys, for like the last 2 years, and we were saying that Disney had many problems, but now they are seeming that they're solving all of them. I'll remind you of the problems, then we'll get into the earnings. The problems with that, number one, their subscription business, right? Their Disney Plus subscription was not profitable, right? That has since changed. Now 5 quarters of profitability with subscribers actually on the rise. Problem number 2 is that they were running into some pricing power ceilings for their parks and experiences division, whereby after the pandemic, inflation went up, of course, and then Disney was starting to see dwindling visitors as people were claiming the prices were too high. So it was the argument was that, well, has Disney's parks and recreation business possibly peaked? That was another point of contention for the company. And division number 3 was their entertainment segment overall with the movie franchise fatigue. Disney was criticized for the past 4 years of relying too heavily on franchise sequels, such as the Star Wars sequels, such as the big blockbuster Marvel sequels as well. And in the past year and a half, the CEO and the management team have made efforts front and center to get away from those same franchises and put out some new content. Well, happy to say that Disney has addressed all 3 of those problems and that the recovery story of their stock is definitely underway. So in terms of their quarterly numbers today, they actually did a very good job, guys. Really, picture perfect for their earnings today. 22% beat on EPS, very good. And a nice little beat on revenue as well, 2.2%, which led the company to be up 10% in regular hours trading today, one of their best days in a very long time. The best point, though, of the entire earnings is this right here, 13.4% net margins. Now, this was Disney's earnings prior to the pandemic. They have not been able to post double-digit net margins in a very long time, and people were very surprised to see them post $3 billion in profit. What is this, Disney back from 2018, 2019? Well, we'll see. Maybe it's harder to kill the mouse than anybody ever thought. Moving on to their earnings, shall we? Disney shares climbed 10% on surprise uptick in streaming subscribers and an earnings beat. Let's have a look, shall we? So the company upped some of its fiscal 2025 guidance and posted revenue growth in all 3 of its business segments. It separately announced a new theme park and resort in Abu Dhabi, very close to the F1 track. Moving on further, Disney, which had previously said it expected Disney Plus subscribers to decline during the quarter, last quarter they declined as well, reported a 1.4 million increase in subscriptions to its flagship service, bringing its global base to 126 million. Now that's a far cry from the market leader, which is Netflix, but still nice to see them on a net little uptick right there. Disney expects a modest rise in the subscribers in its current quarter, which was also unexpected. Revenue for its direct-to-consumer business rose to $6.12 billion, up 8%, and was again a profitable division for the company. It was unprofitable for so long, but now 5 quarters in a row for profitability for the streaming service. Moving on further, Disney now expects a full-year adjusted EPS of 5.75, an increase of 16%. That was an estimate beat, so they raised guidance on 2025. I'll show you the estimate because it doesn't say in the article right there in case you don't believe me. The estimate was for end-of-year EPS of 543, so a very nice almost 5% increase on EPS guidance right there. Disney's net income for the most recent quarter increased to $3.3 billion almost, 13.4% net, guys. Nobody was expecting that. Everybody was quite surprised. So very good for them. Disney's overall revenue was up 7% year over year. Also very good for a company that had only been managing to grow revenue 2-3% in every single one of the last few years. 7% is a very welcome change. Revenue for the entertainment segment, which includes traditional TV, direct-to-consumer streaming and films, increased overall 9%. That was very good. So moving on further, the one piece of the bad news for that entertainment segment was, of course, they still have linear TV, yeah? Linear TV continued to drag on overall results with revenue falling 13%. Disney's still somehow making $2.42 billion on that one. Revenue for the Disney sports segment, their other segment, right, rose 5%, which was also good. They aired 3 college football playoff games and 1 extra NFL league game during the quarter, leading to higher ad rates and viewership. So the sports segment, largely led by ESPN, was moving higher over the quarter. For fiscal 2025, Disney said it expects the sports segment operating income growth will be up 18% year over year, higher than the 13% growth it had previously forecast. So very nice right there, guys. The business is growing, that sports division, and also getting marginally more profitable as time moves on. Now, the third segment of the business, if you're a bit lost, they have entertainment, which is films and streaming. They have sports, which is largely ESPN. And then they have the overall experiences business, which includes parks, cruises, and resorts. That revenue rose 6% during the quarter. So every one of their 3 major lines of businesses was actually up. The domestic theme parks saw revenue rise 9%. However, international was still a little bit weak for them, dipping over 5% overall. Their park in China, not doing too well at all. The one in Japan was fairly good, but international remains a little bit of a pain point for Disney, and that's been the case for the last 2-3 years, although the domestic one has been quite good overall. So when we break down all of those various lines of business for Disney, you can see here over the last trailing 12 months for the entire 3-year period here, you can see that entertainment in blue has been steady up and to the right. Their sports revenue as well has been steady up and to the right. And the purple column right there, which is experiences, parks, cruises, stuff like that, right? That is also steady up and to the right. So everything growing and moving in the right direction. If I was a Disney shareholder today, I would be quite happy. I don't own these shares, all things considered, but I have played them a number of different times for a swing trade. And if ever it does come back down here somehow under $100 again, because the market erodes back down into support 90 to $80, I will be contemplating playing a swing trade on this again, because I think the business is moving everything in the right direction. It's taking them a long time to correct this ship, but now the company is taking good steps in the right direction to make that happen over time. But the recovery story will probably take still a few years to fully materialize to where Disney is back to growing EPS and revenue at very high clips for the foreseeable future. So at $100, is it a good buy right now? Let's have a look. It's trading at a forward PE of 17.4, which is not that bad in the historical context of Disney overall. It's trading at about a 1.45 peg, which is also not that bad, and trading at a trailing 12-month free cash flow yield of 4.85%. Also very solid. I do not mind these numbers. Of course, it was a much better buy down here in the low 90s to mid 80s, but even at $100, guys, it's not objectively that bad. If you have a long-term time horizon on the company, forward price to sales is also a 1.97, which is also very good. So on paper, I could not argue that the company is extremely cheap, that comes into play when it's all the way down here at the low $80 range. But at $100, it's not as if you're really missing the boat. It's still very decent value for Disney down there. And as I said, if it approaches down there again, it may be worth a swing trade, but I would not be even opposed. I mean, it's not high enough revenue growth for me to have in a long-term portfolio, but if you're looking for something like this in the lines of business that Disney operates, I wouldn't say it's a very bad deal overall. Those are my thoughts on Disney. And now the last one, guys, which is going to be another very popular one, but somewhat controversial because of the valuation. It's going to be ARM. So talking about ARM right now, you can see that in the after hours, the company is down 11%, and this is in spite of posting very good most recent quarter earnings. As a matter of fact, they did beat on EPS here by 4.86%, but the guidance was slightly, ever so slightly underwhelming. Now, ARM has always been a fantastic company. There's no secret around that. They have very good architecture, and it's a royalty-based business. The concern, at least for me, has always been around the sheer amount of stock-based compensation that they do. It's a very high gross margin business overall, guys, one of the highest in the entire market, as a matter of fact. Take a look. Their gross margins right here are 94%. It's just the struggle with this company is the fact that they continuously failed to bring more of that money to the bottom line because of, in my opinion, egregious stock-based compensation. Some of their operating expenses, as we'll look at in these earnings, are due to research and development. And when you're on the cutting edge of technology, especially chip design technology, you have to have your R&D expenses. I'll give them that. But selling, general and administrative expenses, and the sheer amount of stock-based comp that they do really takes away from this company's earnings power overall. Let's take a look at some of the numbers, shall we? So moving into the article right here, ARM shares drop on a very weak forecast. So they did do a good job on the current quarter. As you can see, we already covered the EPS, but the revenue wasn't there. They actually beat on the revenue, 1.24 versus 1.23 billion expected, but they issued weaker than expected guidance for the current quarter, which is Q2. Let's have a look. They said revenue will be between 1 billion and 1.1 billion. The middle of the range is below, the 1.05 is the middle, below the 1.1 billion average analyst had estimated. And in this market, you have to be absolutely perfect or Wall Street will punish you, especially when you have a high valuation. Earnings per share forecast will also be between 30 cents and 38 cents, while analysts were expecting 42 cents. That is a pretty big miss. That's a 20% miss on the EPS number for next quarter. Now, SoftBank controls about 90% of ARM, and they did take them public in 2023. At a very expensive IPO price, in my opinion, but I digress. Anyways, the company claims 99% of premium smartphones are powered by ARM technology. And this is pretty much true, guys. And they are claiming more and more of the x86 market as well when talking about computer chip designs in that process too. Royalty revenue in the quarter rose 18% from a year earlier. Net income fell 6%. That's not very good, especially when you have such high gross margins. There should really be no excuse for net income to be coming down. If anything, you should be working harder and harder to bring more of that very juicy gross margin down to the bottom line. Revenue, though, did jump 34% from a year earlier, which is very strong. Let's have a look at some of the numbers for ARM Holdings overall, some of their presentation slides, as you can see. So total revenue was up 34% year over year, and trailing 12 months free cash flow was down, but it's because of a one-line item, which will, I'll spare you the intricacies of it, of course, but it's a one-time line item that we see several times throughout these corporate earnings. More complexity per chip, more chips equals more ARM, and this is true. They have several very large segments of the business, of which they control a dominant portion of market share, whether it be in mobile, cloud compute, automotive, or even Internet of Things and embedded. Now take a look at this over here. They have record licensing and royalty revenues. Very, very strong, guys. The royalty revenues are dark blue and the licensing revenues are the light blue section. You can see that both segments of the business are expanding by a very wide clip, and revenues are really coming over and above what they were in previous years when they're being measured. Now, the ARM v9 adoption is driving royalty growth. They collect royalties on every single architecture that has been issued in the past. They are still collecting royalties on people who use ARM v7 or older, all the way back from 2016. As you can see, as they update their architecture, of course, people go for the newest edition of it. But just to say that the royalty revenue business is a very long-standing one for each which one of the iterations that is currently still in the marketplace. Now, they also have very good gaining share. They also have very good market share gains overall. Here you can see that they say that mobile applications for them is 99%. Consumer electronics now has moved from 24 to 30%. Cloud compute now from 9 to 15. Networking equipment from 23 to 28. Everybody's switching to ARM architecture right now. And also we have automotive 36% to 41. Internet of Things has stayed flat, but the total market share opportunity for the company has been steadily increasing. And every time I've shown you one of these for the last 5 quarters that we've been covering this stock, it goes higher and higher and higher. Now, one of the last slides that I wanted to show you for ARM as well is just the fact that they still do have a decent amount of money in the current pipeline right now. Annualized contract value, a metric for normalized license and other revenue, continuously increases. So not only do they have more contracts in the pipeline, they keep adding more every single year, guys. And without exception, truly, when you measure Q4 or Q4 this year over Q4 of last year, or pretty much most quarters year over year, you can see that all lines of businesses are improving, especially their licensing obligations right there. Remaining performance obligations had a lot of them have been cashed in right now. A lot of them have been cashed in right now, but still sitting at a very cool right now remaining RPO of $2.2 billion, which is fantastic. That is roughly over almost roughly a year of revenue for the company. So looking pretty good, although it was down quarter over quarter. That's just because they delivered a lot of the stuff over this current quarter. You can see some of those delivery peaks as time kind of moves on, and today was really no different overall. Now you can see that the market share by chip value is also higher as they continuously purge x86 from the discussion, right? x86, you can see, is the dark blue segment. It's been losing market share, guys. Who is the major provider of x86 architecture? Intel. Now I'm gonna look at the ARM down here. It's been steadily increasing from 2021 from 38% all the way to 49%. Those are big gains. Other chip architectures have about 12%, but that's not really been a big thing. The one thing you should understand by this graph is that ARM architecture is quickly outpacing the growth of x86, and it's really not even close overall. So you can see that they are still collecting royalties on products developed in the early 1990s. As time moves on, they still get paid. Now, what is the problem for this company? Because all of this seems really good, right? Seems like a foolproof business. And actually it is. If they were to solve this one problem right here, guys, I swear to God, they would bring in so much free cash flow and so much net margins that the valuation would be much more manageable right now. But because of the fact that they spend so much money, and I'll show you guys, just so you guys know what I mean, yeah? So here you go. Here's your revenue stream, right? Look at the cost of sales. It's nothing. It's literally nothing, guys. You're talking like 3% of revenue is cost of goods sold. That's nothing. R&D, you have to give it to them, of course. Not all of this R&D is actual R&D. They break down stock-based compensation into these two respective segments. They could do a better job of managing SG&A, but maybe they've listened to my videos because it is lower than the same period of time measured from 2024. But of these two components, which takes away a lot of those juicy gross profit margins, you end up with something like this. Did I highlight it down there? Let me just see. Stock-based compensation right here, $193 million in the quarter. $193 million, right? I'll remind you, they made $1 billion. It's literally almost 20%. It has been 20% every single quarter since the company's been public. And I keep saying it. It's just too much. It's just too much, guys, right? And overall, their EPS would be so much higher and their valuation would be more manageable. So at 110 right now, overall, is the company a good buy? Well, fundamentally, the company is a beautiful company. They have very high gross margins. They have a fantastic product. They have a very good R&D team, and the management team overall is very good and they know how to execute well. However, if they fix this one little problem, it becomes an instant buy for me. Still waiting for that to happen. What's another example of a company that stock-based comp has eroded shareholder value over time? Well, I'll show you one, and we haven't covered it in a while, but it's this company right here. Snowflake, okay? So ARM hasn't really moved ever since the last year overall. And in terms of $110, they're currently still trading at a forward price to earnings ratio of 54, which is objectively high. They have a high EPS growth rate. I'll give them that. PEG ratio is still at 2.19, which is very high, guys. most of all semiconductor companies right now are trading like around a 20 forward price to earnings. Almost all of them. Micron is trading around like a 10, 11. NVIDIA's at a 20. Several other names like AMD we covered yesterday is around a 20. So many solid semiconductor companies like ASML is also trading around a 20. So many of them are trading at a 20. This is still trading at a 54.72. Now, I won't take anything away from them, of course. Their balance sheet, guys, is super strong. It's super strong. They have no debt, a lot of free cash flow for the size of the company, and a lot of cash on the balance sheet. The growth of their EPS profile is also very stable and very good, up and to the right, revenue up and to the right, as they keep getting market share. And it's a very profitable type of business because of that royalty revenue. But right now, the price to sales, because their market cap is so high, and they don't make that much money on a yearly basis. They make about $2-3 billion. Well, now it's going to be about $3 billion, $4 billion into next year, whatnot, right? So they make a good amount of revenue, but their market cap is so high, guys. They have a 26 forward price to sales. A 26 forward price to sales. You guys thought AppLovin was expensive at an 18.2, huh? Well, ARM is even more expensive. It is the most expensive company in all of semiconductors, and it's not even close, which sucks because arguably they have one of the most highly profitable businesses in all of semiconductors, right? NVIDIA, to give you an idea, is at a 14. So this is way too high, guys. ARM, in my opinion, is a great company to hold for the long term. However, we have to get a favorable price. At 80 bucks down here at the tariff lows, that was a good price, objectively speaking, right? And I would not mind taking some swing trades down there. Suffice to say, guys, if you're buying ARM right here, you have to have a very long time horizon, and hopefully they do correct this issue. But overall, a fantastic business. I would be willing to explore the company down here. But right now, at this current valuation within semiconductors, I think there are far better deals, and that is just my opinion. That is everything for your earnings breakdown. Hopefully you enjoyed that. Now, let's get into some charts, shall we? So moving into the SPY, which was up 0.42% today, I will remind you in terms of the preview for the rest of the stuff we have for the week, not much, guys. Tomorrow, just some initial jobless claims. We get that every week. Then we have a bunch of Fed members speaking on the Friday session. But in the next 2 days, maybe we get some trade deals. Scott Bessent yesterday was saying he had ongoing negotiations with 17 major trade partners. Everybody's waiting for that. Number two, everybody's waiting for the big Trump announcement that he said was going to happen. Well, yesterday he announced there was going to be a big announcement. Remains to be seen. Is that going to happen tomorrow or Friday? A lot of speculation that that might have something to do around semiconductors during Trump's visit to Saudi Arabia. So we'll pay special attention to that. But overall, guys, no more macro events for the week, and earnings are also winding down. Although we do have some very interesting companies tomorrow. Shopify, Trade Desk, Coinbase, Mercado Libre was today. Cloudflare, other stuff like that. No more really big companies overall. Yeah, just some kind of secondary companies right there. Now, in terms of the SPY, we haven't done anything since Monday, guys, so the levels still stay firm. In terms of the daily uptrend, we are still in a daily uptrend, looking for a higher low. Anything above 541.20, looking for a higher low. Maybe for some trend continuation, if the Trump big announcement is good, or we announce some trade deals. We know that there's going to be some talks between the US and China over the next few days as well. If all of that goes well, the bulls can have a good chance of pushing into the resistance highs, which currently stand 575 up to 585 on the SPY. The weekly time frame is still looking quite good. Weekly uptrend right now. Any pullback, if ever those trade lows are not announced, or we get some bad news and we erode into a daily downtrend, just understand the bulls have a lot of space. Anything above 508, looking for a weekly higher low, maybe for a second attempt at smashing through here. But all in all, the markets stay poised and are kind of in a limbo mode, as I was saying, right? Earnings have been good. We might be getting some trade deals. But is it too little too late? I'll remind you, the narrative for volatility for the next 2 weeks will be this voluntary trade recession as we battle with a dwindling of imports into the country now. Companies have good inventory levels for now, but the media is going to start running with any layoffs to transportation, dock workers, as we're having less containers come in from China. Some people might get laid off. You may see some empty shelves surrounding some certain products. That is going to be the volatility narrative for the markets, in my opinion, over the next 2 weeks. This one right here and any positive trade deals will be doing battle every single day, guys, for the next 2 weeks as we battle between trade deals. Can we get the trade deals done? Can we take the tariffs off before hard data comes and before recessionary data possibly comes? So you need to piece all that into motion. If you want my opinion, it's very simple. I'm looking for volatility on certain stocks, writing short puts under the market, or waiting for certain items to come down into my levels to be able to swing trade them long. I'm not overly positioning right here one way or another. I have some hedges to the downside, and I'm also waiting for downside to play some short puts on my favorite companies below the market, right? In terms of a long portfolio, it's always been so simple, guys, right? DCA, every single paycheck, 10-15% of your paycheck should be invested in your future self, whether that is buying high quality companies at good prices or buying high quality ETFs. It's up to you, but statistically, DCAing has been the proven method to work the best over time. It's fine to keep a little bit of cash on the sidelines, 10-20%, and kind of wait it out if you're under the impression that hard data is going to hit us anytime soon. But to stay 100% in cash and try to time the market, you know, sometimes it's not as simple as it sounds, right? Onto the QQQs right now. Qs up about 0.39%. The analysis is the exact same right now. Daily uptrend is very nice. Haven't really done much. Still looking for a higher low. Anything above 462, looking for that higher low. Maybe for trend continuation expansion into resistance, 510 to 493 on the Qs, which is this zone of all those people, all the way up there. Looking nice right now. We're back testing into support 481 to 466. Hopefully the bulls can play some defense and get us going. If they don't and we lose this and get into a daily downtrend, I'll remind you the weekly uptrend is still very well in motion right now. Anything move down wise would be looking for a higher low, anything above 429, higher low, maybe for a second attempt at that range. Or if things get really bad, you might be able to erode this a bit more and just get trapped between these two levels, right? These guys and that guys. It's kind of how we did all the way back there. Now, moving into financials, up about 0.59% on the day, and also the chart looking fairly similar to the rest, right? We know we have a nice daily uptrend underway right now, still looking for a higher low, anything above 47.50, looking for a higher low for possible further trend continuation. Maybe they're doing it right now. If ever we unwind into a daily downtrend, well, you guys know the drill, right? Who's in control? The weekly bulls, of course. Weekly uptrend looking very nice. Any move lower, we'll be looking for a higher low, anything above 45.17. Higher low for further trend continuation. Financials looking very strong and big support below us, 48.32 to 46.81. If we dip into this area, that may be swing trade criteria for me. I'll keep you guys updated, but that is where I'd be looking because right now we're at a midpoint between resistance and support so no trades right now for me. Moving on to XLV Healthcare right now, the drag on the overall S&P for roughly the last 2, 3, 4, 5 weeks of time. This is the only sector, guys, the only major sector that cannot get a weekly uptrend in motion. A very wide range of accumulation right now. Pay special attention to these lows, 131.56, deep into support, right? All of these guys are going to be a very big level of support for the markets. You can move this box either way, yeah? Just as long as you understand there's a very big amount of bulls sitting there, and the 200 weekly is sitting there as well at 130.55. How I'm playing healthcare, I'm playing the names individually, going shopping for some companies that I like very much at crushed valuations right now. UNH is just one of those examples that I bring up every single week, but you can find other examples for some swing trades, especially for short puts under the market, such as MRK in this lower range of support, which is all those guys from all the way back there. And now moving into the index that actually got most of the news today, semiconductors. So semiconductors did most of nothing all throughout the day until we got that news headline at the end surrounding the global drop, or rescinding rather, of the chip curb control. So daily uptrend is clear as day right now. Higher low possibly being set. If we crack the highs of this past Friday session, you will have a new leg of daily uptrend underway, and we'll be targeting the top end of resistance up here, 232.89. However, if you lose this, it would be a new daily downtrend, and you would just be looking for a weekly higher low at that point, anything above 180.42, looking for a weekly higher low, maybe to have a second, or rather third attempt in this resistance range. But the weekly bulls are still in control of the weekly time frame. Not looking too bad, but still gonna have it be a battle, guys. Gonna be a big battle with overhead resistance. But semiconductors looking pretty good right now. We are far off the fear lows overall, and several companies are still at attractive valuations. Micron is one of them, ASML is another one, and TSM is also a third that I like to play. Special shout out to NVIDIA, special shout out to AMD. Suffice to say, there are many deals across the sector right now. Just depends what's your favorite one. On to the Russell right now, up about 0.33% on the day, looking pretty good. Still hunting for the daily higher low at this point, anything above 190, looking for a higher low for possible further trend continuation. Right now, we are still trapped in this resistance range. 200 down to 190 roughly, which is a very big range of resistance. It's come up in consideration a few times so far. If ever we crack through, the next line of defense for the bears is 208 up to 215. And if ever we roll this over, as we very well can, you'll just be looking for a higher low, anything above 180, looking for a higher low on the Russell, maybe for a second attempt at breaking out of this range. So growth stocks, not looking too bad, but I would be looking for any pullbacks to further position on this one. And then lastly, the Dow Jones. Dow Jones also unable to crack its own resistance range. You can see that 41.3 down to 40,006 has been a resistance range the Dow Jones has struggled with now for several weeks in a row. However, that being said, the bulls are in short-term control, looking not too bad. Daily uptrend is set in motion, looking for a higher low, anything above 39.8, looking for a higher low, maybe to crack this range. If we roll this over though, right? Daily downtrend, you'll be looking at a weekly higher low, anything above 37.8, looking for that weekly higher low. Maybe, if they can't get it done in one clean shot, maybe they have to do it in 2 steps. So we'll stay posted on the evolution of these ETFs overall. Onto the VIX right now, the VIX down 4, but still not moving, still hugging the 23, 25 range. And I keep saying this every videos. During times of economic uncertainty, the VIX can stay high. 2022, post-COVID, election cycle and tariffs, or rather, tariff segment number 1 back here twice in 2018, election cycle, Trump number 1. And then, of course, we had the flash crash and the great financial crisis. Suffice to say, I am expecting the VIX to have random spikes here and there as we continuously move through volatility headlines. This is going to be the next one for anybody paying attention. That would probably warrant another spike on the VIX. I'm pretty sure we are through maximum volatility, but to say that we're going down to 12, I think would be somewhat a little bit, not very prudent overall. Onto the dollar index right now. Well, the dollar actually up 0.5% today. They still have a very big range to reclaim right now, 102 down to 100. I mean, the indexes have rallied, right? But we're not really seeing much participation from foreign people wanting to buy dollars. And until that changes, I think you're not going to be able to see the broad-based asset rally, stocks and bonds that everybody's looking for. Too much uncertainty in the markets for us right now. We do have a break and maybe run into support for maybe a rundown. We will see, guys. We'll see. The dollar is a very complex trade overall, but it's going to be curious to see. One could make the argument as well that if the U.S. wants to make its exports more competitive, well, they're going to need a weaker dollar to do that. So that could be another argument for the dollar pointing to the downside, but definitely under the lows of the last 3 years of trade. Yields actually were down today off of the Federal Reserve meetings and comments, of course. Overall, we are far off the peaks of uncertainty right here, which saw us tick up into 4.5% after Liberation Day. Seems to be several Trump and Powell puts into play. Trump being very responsive to some tariff exemptions and stuff like that over the past few weeks. And Jerome Powell continuously saying that they have the tools and they will step in if ever things really start hitting the fan. So yields are trending to the downside, but we know until there are lots of foreign buyers of U.S. bonds, we will not see the traditional bond rallies that we're used to seeing recently. Yields still remain a bit high. It's a very complex trade, which is why bonds still stay muted. I still do believe the bottom end of this range on TLT is a great buying location if ever you want to pick up some bonds or have a swing trade on this. But as I said many times, guys, it's going to take a very long time for this trade to play out. Think like, 2026 probably for the lift that you're looking for on this trade overall. That is all of your overall macro sector rundown. We can take a brief look at gold right now. Gold was currently up. Well, it's up right now, but it's down on the day. Gold actually retraced about 2% after back-to-back almost 3% days. Looking for a little bit of a pullback, maybe looking to set the higher low and run. Daily downtrend, engulfing move. They're now sitting on these tops right there. They could come down and sit on the 12 EMA a little bit more. Looking for the breakout, retest, and maybe run, question mark. That would be a trade entry opportunity if you're looking for it. But on the weekly time frame, bit of time frame contradiction right here, yeah? Glorious move to the upside, higher low. If we get a higher high and a rollover for XYZ reason, guys, it'll be a weekly downtrend into monthly consolidation. So short term, what does that mean? If I'm taking longs here, I'm definitely trading with a stop loss, because if we unravel, right, you're looking for weekly consolidation, and that will be a monthly consolidation period as well, which we may come back and test the 12 EMA as it curls up, maybe closer to that $3,000 mark. It is currently still monthly overbought, so keep all of that stuff in mind. Now let's move on to our big tech name, shall we? All right, so taking a look first at Apple. Apple, the recipient of going down on its own news, because maybe it's going to lose that $20 billion contract with Google. We will see. We'll keep you posted. But Apple right now, definitely not having the best day, down about 1.14%. Still looking for a daily higher low. But now we've given back way too much of this move. Whenever we give back too much of a move, I mean, the daily uptrend is still technically on the table. They have support below 196 down to roughly 187. But when you take back so much of a move, guys, right? Take back so much of the move. Take a look at the fibs right now, yeah? When you take back 78% of a move, two possible scenarios arise. One is a consolidation range, trapped between two levels, support and above resistance, which is roughly 210 to 220. Or you open the door for something like this as well, yeah? If it's the latter portion of the component, I'll remind you, they would not have set a weekly uptrend. Flushing the lows, you would just be going back into a very wide area of consolidation. Hopefully the bottom end of the range holds up, but I would not be minding selling some short puts on Apple down here at the lower 180s when the valuation is a bit more manageable. So we'll keep an eye on this trade one day at a time. If you did want to take a swing trade here, there is a swing trade opportunity from level to level with a tight stop loss. Your stop loss is the daily higher lows there. You're banking on the support zone, and the take profit area is there. It's a pretty good risk to reward, but notice I say risk to reward. There is some risk associated to this trade, so please keep that in mind. And as I said, I'm not really adding any Apple shares. The revenue growth is a bit too slow for me right now. But if it does come down a bit more, I'll be interested in playing some short puts below the market. On to AMD right now. So AMD up about 2% after their earnings yesterday and trying the best that it can to just move into a new segment of the daily uptrend. Keep in mind though, resistance, we are in it right now, all the way up through 113 down to roughly $98. It's been a big area of resistance for AMD for quite a long time. It was previous support there, resistance here as well, and now resistance once again. That being said, the bulls are making good progress on the weekly. We can see a clear weekly uptrend. So even if we lose this temporarily, daily downtrend, you're looking for a weekly higher low. Anything above 84, looking for a higher low, possibly for a second attempt at breaking through. One thing's for sure, the valuation, as we said on earnings, is cheap. If you didn't see my earnings recap yesterday, definitely go and watch that. Long-term bet, decent. For the next 2-3 years, I wouldn't be surprised if AMD can make it all the way up to 140, up to about 180. That would not be so far-fetched with the revenue growth that they have underway right now. If we pull back, decent time to add for that thesis for long-term, or if they do pull back significantly, I'll be looking to sell puts once again under the market. Moving on to Amazon right now. Amazon up 2% overall today, but just trapped, doing a whole lot of nothing. That being said, daily uptrend is still underway for Amazon. Higher low is now set. If they break 192.81, that is a new leg of this daily uptrend. I will be looking to actually mount above this big line of defense area of resistance, which ends at about 191. What you would like to see is really a break above, retest and run. That would be a very juicy swing trade entry, in my opinion. If they cannot get it done and instead flush these lows, set up a daily downtrend, well, you know you're into weekly consolidation. At that point, anything above 165, looking for a higher low, and I will be gladly sitting down there to sell some puts in this market. Amazon's still a fantastic add for a long-term portfolio, as most lines of business for them are moving to the upside, double-digit numbers. Moving on to Google right now. Google down 7.5%, was down as much as 9 today, and coming at the bottom end of the range of support. So one thing's for sure, daily downtrend, no new net highs, and a clear lower low. Daily downtrend for Google, that means that they're in weekly consolidation right now and almost forfeiting the weekly higher low. They had a weekly uptrend leading into after earnings, and now they gave it all back. So one of two things is going to happen. If we flush this, you open up the door for this, or you just open up the door for somewhat of an awkward tightening range between two levels. The level that they could not break, 175 down to 161, and below us, 150 down to roughly 135. The way that I'm playing this, quite simply, guys, no, I'm not buying leap calls. I'm not doing many swing trades to the upside, but I will gladly write some short puts under the market in the lower 140 range if I can find them, because the valuation here at 153 is extremely cheap. And by now, I mean, people have de-risked this stock almost entirely because of the, issues with their search business, the number of lawsuits that Google currently has right now. But they do generate a tremendous amount of both net margins, great cloud revenue growth, advertising is also good, and the amount of buybacks that they do. It's a tremendous company overall, but has just been plagued by negative headlines now for roughly the past, 6 to 9 months? Moving on to Meta. Meta up 1.62%. Nice move on Meta on the day, but not cracking the new highs just yet, not making any lows. So just kind of a tightening range at the top right there. That being said, daily uptrend is clear as day. Still looking for a higher low. right? Anything right now above 530, looking for that higher low, possibly for further trend continuation. But one thing they have not still done is crack above 600. It's a nice weekly uptrend, but you need the continuation. Give me a breakout, retest, then it opens up the door for a possible long, something like that. And if ever we lose it and just move down, you're just looking for a higher low. And even if you erode the uptrend, daily downtrend, you still have a lot of space here. Anything above 41, looking for a higher low. If Meta makes its way down there, that is also 2 trades for me, swing trades. Break, retest, that's a swing trade, and also come down below into support, that's a swing trade location, and also opening up the door for some short puts well deep into this big support range, which ends at around 450. Meta valuation right now is still very cheap. They had fantastic earnings, and the valuation does definitely support some upside growth in the next few years. So still a good position for a long-term portfolio, in my opinion. On to Microsoft right now. Microsoft basically flat on the day. Not doing too much after their earnings, but who can blame them, right? They had a very good earnings performance. Daily uptrend is very nice. Still looking for a higher low. Anything above 385, looking for a higher low. Maybe for a second attempt at this resistance range if they cannot break it. I did not close this box green just yet, guys, because they haven't cracked it in a convincing fashion. They just stalled, right? That being said, if we come down too much and open up a daily downtrend, well, you're just looking for a weekly higher low at this point. Anything above 355, looking for a higher low. For some trend continuation, same thing as Meta, breakout retest, that's an entry for a trade, or retest of the 405, 410, that is also a swing trade for a long. Microsoft, fantastic company for any long-term portfolio as well. Moving on to Netflix right now, Netflix up another 1.56%. So apparently they did set the daily higher lows. They're looking for a little bit more here, guys. So daily uptrend is clearly in motion. Higher lows have been set right there. I mean, it's not, they haven't technically set them, guys, but now with higher highs, that is going to be a daily higher low. The reason I say it's not technically is because they never lost the hourly uptrend. They just had a nice gap down and the bulls reclaimed it right away, yeah? So you can say the daily higher low is here. If they ever do flush this, it will be daily downtrend. And now the weekly, if that does happen, you're looking for a weekly higher low. Anything above 825, looking for a higher low. Maybe in around the previous all-time highs, right? The previous ones here, 1,050 down to $1,000, and confluence with the 12 EMA, which is curling up. Maybe you're looking for something like this on any consolidation period for Netflix. Looking very strong though, still very strong. It's just that at 1,150 right now, the valuation is somewhat stretched. So I won't be adding any shares to Netflix, but in the event it comes down, maybe we'll revisit it at that time. On to NVIDIA right now, up 3%. We'll see if they get more continuation tomorrow from today's headlines. Pretty sure a lot of people will be talking about that tomorrow. So maybe we get some bullish conversions into NVIDIA. One thing they did do today, they finally closed above. They finally closed above the 115 area of resistance. Daily uptrend is nice right now. Higher highs are being set. So now any move lower from here, looking for a higher low, anything above 110, higher low for maybe continuation. On the weekly, finally, if they close the weekly time frame like this, confirmation of a weekly uptrend. It was a double top. Now they have confirmation. If they make their way into here, this is the next area of resistance, 125 up to about 135 for some expansion on that chart. Even around 116, the price to earnings is manageable. It's about a 25 right now. I did it at 100, but just add, 15% to that. So not too bad. It's about like a 25 right now, and the PEG ratio should be right around a 1.1. Still very strong for NVIDIA overall. Looking very nice for that expansion. Curious to see. I did open a disclaimer, full disclaimer, a position on this. I went with the call debit spread when the news came out for July, 125 to 130. I paid about $1.70 for it. I'm looking for some upside appreciation, but I'm not going to chase it with too much size. If it does pull back into here though, nice short puts down here in the lower 105. On to Tesla. Tesla up today, 0.32%. Not that bad of a day for Tesla, but still struggling around its lows. It's just been consolidation for Tesla, right? Trapped between 294 and 270 down below here. That being said, we are in the confines of resistance. Let's call it 300 down to roughly 260. It's a big level, guys. It's played resistance, tons of times for either resistance or support, depending if you're coming down into it, if you're coming up into it, right? It's been a very hotly contested area for Tesla for a long time right now. In the event you break it to the upside, well, the new daily uptrend will be confirmed, and you're just going to be looking for weekly uptrends as well to now be formed and looking for one leg higher. The next area is 378 to 400 on those. And if we move down, well, we're just going to get trapped between resistance and support, which stays down below 220 to 210. So there's no trade for me right now on Tesla. If we move a bit lower, maybe I'll consider writing some short butts down here, maybe, but no trade for me on Tesla right now. Just somewhat unclear price action overall. But by all means, right, if you want to take a swing trade from here with a very tight stop loss and go for the range break, completely up to you. Palantir now up 1.5%, recovering a little bit from their earnings drop. We covered their earnings on Monday. They had very solid earnings. It's just, you know, high expectations, and they delivered, right? It's just, you know, when you have such a high valuation, people are just constantly expecting more and more and more and more. And sometimes you just get hit with the NVIDIA effect, right? So daily uptrend is clear as day. Still looking for the daily higher lows. If we move lower, we got a lot of space. Anything above 89, looking for a daily higher low. Maybe for a second or rather third attempt at breaking the all-time highs. If you falter and move into a daily downtrend, the bulls are still in control of this weekly as well. Anything above 66, looking for a higher low. For further trend continuation, I'd be a big fan if we can see Palantir pull back into the support range, 96 to about 90 bucks. I'd be a big fan of maybe going for a swing trade from there and writing some short puts, especially in the lower 80 range. But fantastic earnings from them. If you didn't see my recap on Monday, I was very bullish on the stock. Keep in mind, I do still have some long-term Palantir shares that I accumulated. Well, first here and then a bunch down there, and I'm still holding a decent portion of them overall. Moving on to SOFI. SOFI up 2.2% on the day. SOFI finally finding its daily higher lows and trying to go for the daily trend expansion again. However, resistance above stays put 14 to 16. That is all of those guys right there. We will see. Can they get it done? One thing's for sure, though, if they set a lower high and flush 12 to the downside, that is a daily downtrend. And unfortunately, you'll just be heading into another leg of weekly consolidation. Good thing for SOFI, though, it was a downtrend. Nice little weekly uptrend right now. Looking for a higher low at this point, anything above 1044. So that's why any dips on SOFI, I am a fan of playing short puts under the market, or even for some swing trade longs or some long-term portfolio buys in the roughly $12 to $10 range. I think the valuation is very manageable down there, and I will be looking to add. We'll take this one day at a time. But for me, a swing trade from here, midway between support and resistance, not quite, right? I'd rather just carry what I have there into here, or maybe just wait for a dip to write some short puts. Onto Uber right now, before last. Uber, 2.54%. We covered them pretty much, their earnings earlier on in the video, of course. Right, or that was yesterday, sorry. Now, back test has been completed. I was telling you guys, watch the back test. Daily uptrend, higher lows are set. Looking for a new higher low, anything above 77, higher low, maybe for higher high. And I was telling you guys, watch the back test of 80 down to 77. We got it right now. Didn't enter any swing trades myself personally today. There were many other things that I was looking at, but not a bad opportunity. We covered their earnings as well yesterday. If you didn't have a chance to cover those, definitely have a look. Or actually, wait a minute. I'm doing too many of these earnings, guys. We covered them today. What am I even talking about, right? We just covered them. It's just I do so many, man. You can't blame me, right? Overall, though, if ever we set a lower high into lower low, daily downtrend, just keep in mind, the bulls have tons of space here, looking for a weekly higher low, anything above 61, looking for a higher low, for possible further trend continuation. Overall, looking very good. The bulls working with a lot of space. If you ask me where I want to write short puts, I want to wait for a decline, and I really want to write some short puts at the lower 70s. I wouldn't mind being assigned some shares down there. And lastly, TSM. TSM up 1.31% today. We will see. Can they get some follow through tomorrow with the semiconductor news? We'll definitely have a look, but daily option is clear as day right now. Looking for a higher low constantly, anything above 160. Looking for that higher low, maybe for some trend continuation. We are back testing support 171 to 155 right now. So you could make an argument that we are going into this next level, which currently stands 183 all the way up to 193. It's a pretty big level for TSM, all things considered, right? Resistance, support, then the flush, back test as resistance again. And on the weekly, looking very good. So even if we forfeit this uptrend and go into a downtrend, just understand, well, number one is big support, yeah. But number two, a lot of space, right? A lot of space between us and the higher lows at 146 for a higher low dip into possibly a weekly uptrend expansion. If we get a dip, might be looking for a swing trade long, but also I'll be looking for some short puts in the mid 150 range. And that is everything for our stock market today. Hopefully you guys enjoyed today's video. If you did, consider dropping a like, would appreciate it for the growth of the channel. Also consider subscribing if you're new. We do these every Monday to Friday after the close. And lastly, if you have any questions, always feel free to leave them down below. I'll be answering all your guys' questions tonight. If you have questions on stocks, options, macro, whatever you want, leave them down below. And I'm always very pleased to read your comments and answer your questions. And lastly, if you are interested in joining a community that focuses on trading and long-term wealth creation by building very solid long-term portfolios, you might consider joining ours. With over 150 members. We all trade the same strategies, we have a bunch of fun in there, and we focus on long-term wealth creation through the trading portfolio and long-term portfolios. You get access to all of my trades in real time, whether they are the wheel trades, selling puts under the market, any directional bets that I might do with call debit spreads or leap call contracts, or share swing trades overall, any long-term portfolio buys that I might do, and also any lottery trades, whether those are directional or a bunch of earnings trades as well. Here are my trades just from the past few weeks, stuff like that. You get access to all of my swing trades and all the trades called in the Discord. You also get access to our private morning live streams, which I do every Monday to Friday at the open for about 2 to 3 hours, where I first trade live and then take all your questions on your stocks, your options, and your long-term portfolios. If you can't be there, they are always recorded, and you can also ask me your questions in all of our chat rooms all throughout the day, and I'm very fast to answer from 9 a.m. roughly to 9 p.m. Eastern. I know, crazy schedules, but I answer everybody's questions in a good amount of detail. You get access to all my private member videos as well, where I derive, or rather I define all the strategies that I use for all the different trading styles that you ever see me do on the channel, many of which I do not publish on YouTube as well. I also have videos explaining how to grow small portfolios, medium portfolios, large portfolios, and which portion of those portfolios should be in which trading strategies, in my humble opinion. And you also get access to all my watch lists, either for options or otherwise. You get access to all my charts. You copy paste all my charts with 2 quick clicks of a button. Get access to all my charts, which includes all the technical analysis levels on like hundreds of stocks, and all the fundamental analysis that you see on my charts, every single stock that we do cover on hundreds of stocks as well. So if you're ever interested in such a community, the link to the community is down below in the video description. Hopefully I see you in there soon. And if not, I guess I'll see you back on the channel, guys. Take care. That is it for me today. Wishing you all a very good day in the markets tomorrow, and I will see you tomorrow after the close. Peace.